Thanks for joining us today on The Close. I'm Marilla Fernandez. Markets close in 30 minutes. Let's get to the stories we are following in the BNN Bloomberg newsroom. The Canadian economy shed about 18,000 jobs in April, pushing the unemployment rate up to 6.9%. Bloomberg economists had been expecting an increase of about 10,000 jobs. Employment losses in April were concentrated in information, culture, construction. Gains were seen in business, healthcare, and social assistance. The Trade Minister, Dominic LeBlanc, says Ottawa will launch consultations on proposals to fast-track federal assessments of major projects and will engage with Canadians over a month-long period. Ottawa is proposing to ensure federal reviews and decision-making timelines take no more than a year once all project information has been submitted. The government's also launching consultations on proposals to diversify Canadian trade. Keeping an eye today on shares of Aritzia, which are up 3.3%. That retailer posted profit for its latest quarter that did surpass estimates and also beat on revenue, with that metric jumping 33% from the year before. Aritzia also issued a revenue outlook for 2027 that beat expectations. The results come as Aritzia continues to open more boutiques and push an app that it recently launched. Here is a look at how the end of the week is shaping up on the markets. The TSX is up today 0.6%, a 199-point gain on the day, and it's over 34,000. Having a look south of the border, the S&P a gain of 55 points, or about 0.75%. The Dow Jones a loss today of 38 points, and Nasdaq up 1.5%, a 390-point move on the day. BCE beat expectations on adjusted profit and revenue for their first quarter. The company continues to build out AI infrastructure and manage slowing growth in Canada's telecom sector. We were joined by Mirko Bibic, President and CEO of BCE and Bell Canada, earlier today.
The catalysts for the beat in the quarter, Lindsay, were really fiber strength, continued fiber internet strength in Canada and the U.S. That would be one. Certainly, a very large catalyst was our AI-powered solutions businesses. We have three businesses at TechCo, which is our technology services division, Bell Cyber, which the name speaks for itself, and our AI data center infrastructure business with Bell AI Fabric. So those three businesses really had a incredibly strong quarter. And I think the third big catalyst was the strength of our digital media business, and particularly powered by Crave.
How much of that revenue growth was organic, as you say, the digital media side maybe, and how much was from M&A and the acquisition of Ziply?
Well, on the fiber side, it would be all in Canada would be all organic. In the U.S., the acquisition of Ziply Fiber in the U.S. closed last August, so we did not have Ziply's results in our consolidated results Q1 last year, so that would be inorganic for now. And in terms of AI powered solutions, it's a large part of that, frankly, is organic, and we opened up another data center at the end of Q1 in Merritt, BC, and it just shows you the momentum we are building on the Bell AI Fabric side of the house, where we have 2 data centers that are now live, one in Winnipeg, which will will go live at the early part of the second half of this year. And of course, there's the largest one of all in Saskatchewan, which is the largest AI data center infrastructure project in the country right now. And what we shared with the street yesterday was all the progress we've made in Saskatchewan, early earthworks, site stripping, doing a lot of work with local contractors. It's very exciting in Saskatchewan.
I did want to ask about the Saskatchewan data center, because I think the last time we had BCE on, we were talking about that. So work has been done. When will you actually start to see revenue from that data center in particular showing up?
You'll start seeing revenue in 2027. So it's the complex will have 4 data centers on site, and we're going to be opening them up, going live one building at a time. So by the end of 2027, we should be at full run rate revenue of approximately $500 million.
Okay, going back to the earnings, it's interesting because despite a slowdown in immigration-driven population growth, BCE is still seeing gaining postpaid subscribers more than expected. Why do you think that is? What's underneath that?
It's so it is a low growth environment in wireless for sure. Given the slowdown in population in Canada, prices are coming down. So networks continue to be globally leading in the industry. I think everyone in the industry is delivering outstanding networks. So consumers are definitely benefiting from what's going on in terms of the price competition and the quality of the networks. In that low growth environment, however, we do have to manage that disruption from an operating point of view. And what we focused on is just making sure we encourage as many customers as possible to choose the Bell brand. So we're trying to encourage, and particularly focused on customers who are going to come to the Bell family and choose Bell for wireless, Bell for fiber internet, which is the best internet technology there is, and particularly our content and streaming products anchored by Crave. Crave on its own, or Crave with in bundles, either with TSN or RDS or some of the other streaming products that we combine with Crave. So the combination of internet, mobility, and content's what's driving folks to the Bell brand, and you see that in the results in Q1.
We've seen some of your competitors within the industry slashing their wireless capital spending in Canada because of the regulatory environment. We've seen that of late. You've pulled back as well, but would you consider making even deeper cuts going forward?
Yeah, so if you look at our CapEx profile, our investments in 2022, we invested over $5.1 billion in our core communications franchise in Canada. And if you compare today to then on a like-for-like basis, our CapEx is now under $3 billion, so a significant drop. That said, we've invested additional CapEx in higher growth, higher return areas. AI data centers would be a very good example of that, with the Saskatchewan investment being really at the top. It's going to be a $1.7 billion investment for Bell over the next 2 years, much of that this year in 2026. That said, it's still, like you said, significant decrease in investments in what was the core business. And essentially, this shouldn't be a surprise. Our peers are doing it too. When you don't have an environment, a policy environment that's conducive to investment, naturally dollars are going to flow into other areas, and that's what you're seeing in Canada right now in what was the core communications business. And it's not just Bell. We just got ahead of it a couple of years earlier than some of our peers.
I want to talk about your debt ratio as well. It was 3.76 at the end of March. You're aiming to get that down to 3.5 times by the end of 2027. Can you walk us through kind of like your plans to do that and some of the headwinds you might be facing in trying to achieve that?
Yeah, so we're clearly on track. You're right. We gave that target of 3.5 by the end of next year. We're going to hit it. Absolutely. If you go back a year ago, in February of 2025, actually, we indicated to the street that we were going to get there in part by divesting of non-core assets, and we said at the time, we were hoping to generate at least $7 billion in proceeds from those dispositions. It's 15 months later, and we've already announced $6.6 billion of divestiture. So that just essentially, our plan is we set targets, we communicate them transparently, publicly, and we track our progress against them, and we communicate regularly, and we execute what we say we're going to do. And this is a perfect example, already at $6.6 billion out of the total of $7 billion. So that's one of the major catalysts to get to the 3.5.
We're seeing churn in your mobile business up last year, though, due to competition kind of in that telecom industry space. What's your strategy to kind of reduce churn while also avoiding excessive spending cuts?
Right. So we had significant churn improvements over the last few quarters. Q1 of this year, so the first 3 months of this year, were anomalous. It was an unusually competitive quarter typically Q1 is slow. That wasn't the case this year. So I think you saw everybody's churn go up. Our strategy, one quarter doesn't make a trend. So our approach is to continue to get churn down. We've given ourselves some targets over the next 3 years as to where we want churn to be. And the way we're going to do that is going back to one of my earlier answers, Lindsay, is to drive as many consumers as possible to the Bell brand, which is the premium brand, and encourage them to purchase fiber, internet, wireless, and content. And if we do that and we execute well against that, our churn will come down.
Mirko Bibic is the president and CEO of BCE and Bell Canada. A reminder, this channel is a division of Bell Media owned by BCE. Up next, Canada's unemployment rate increased 6.9% for April. We'll take a look at the factors feeding into that when we come back. Canada lost nearly 18,000 jobs in April, moving the unemployment rate up to a 6-month high. Let's get some perspective on this from Dylan Smith, founder, chief economist at ARC Macro. Thanks for joining us today.
Good to be here, Maria.
Would you say that increase to the rate is mostly from more people looking for jobs?
A bit of a combination of both. So, as we heard up front there, employment did fall. There were, less jobs in the country in total than there were before. But also we saw participation rising, breaking the trend actually that has been ongoing for a few months. More people entering the workforce this month, and that actually had a larger effect on the unemployment rate. So we had about 33,000 people coming in to the labor force, and a drop of 18,000 jobs, and that was enough to add those 0.2 percentage points to bring the employment rate almost to 7% again.
Historically, is there a time of year where more people enter the workforce?
Yeah, so this brings up the notion of seasonal adjustment. The headline figures we get from StatsCan are not seasonally adjusted. And so, if you do run a seasonal adjustment on these numbers, and the official numbers are out there if you look for them, there were actually a small number of jobs added. And so usually at this time of year, based on that, we see things cooling down a little and then picking up again with seasonal working over the summer. So, there's a few factors at play that are making the data wobble around a little bit on the margin. But I think the overall message here is that, the labor market's not as strong as we would like it to be, and we can get into the reasons for that.
Okay, so let's talk a little bit about some of the details here. The goods producing sector, which is heavily affected by American tariffs, lost almost 27,000 jobs in April. Do you see this trend continuing? We've had some U.S. court decisions that go against the American tariffs. So I'm just wondering if this could improve in the next few months.
It could improve. It's all down to what happens in negotiations around CUSMA. And I'm not going to stand here and predict what's going to happen there. We can run it through a few scenarios, but if you're a business trying to plan for the next 6 months, 1 year, and you're wondering about, how much staff should we bring on to meet a potential increase in orders from abroad or a potential decrease if negotiations don't go well, it's very, very difficult to make a decision. And so what we're seeing is that, sectors that are more exposed to trade with the United States and trade with the world are creating less employment or are losing employment. And, stickier services-based industries that are more correlated to kind of just domestic conditions, healthcare, professional services, that's actually doing quite well. So, everything, like with most things at the moment, if you want to look at the outlook, there's a huge binary around what happens in these trade negotiations. And it is fundamentally uncertain, which is why you aren't getting firms making big decisions yet.
Yeah, putting us back almost 18 months when we were waiting for the tariff announcements and what that would look like. Okay, you mentioned healthcare, for example, as a gainer, which does make sense. Are there other sectors of the economy you see as being resilient?
Well, I think one of the most interesting ones actually at the moment is the information services sector, which I think posted the biggest or second biggest raw decline in jobs this month, but actually is well above where it was trending in 2025. So this month's particular numbers are a bit misleading. It's actually been a good source of job creation. And this goes into the debate around AI and the skills that may or may not be being replaced. We believe quite strongly actually that demand for for coders, for software engineers, all these types of skills is actually going to be rising more and more as AI starts to sort of move its way out of just the tech economy and into the rest of the services industry and beyond. Because you're going to need people who know what they're doing to implement it, to work out how it feeds into how a business runs itself, making sure that quality is there, looking for issues. And so, we see that as actually a very high potential for robust job creation, no matter what happens on the trade side.
We don't have a Bank of Canada here that has to look at labor and try and make sure the labor front is secure, but they will take that into consideration for what they do. If you were the Bank of Canada and looking at the numbers today for job losses, as well as the possibility for inflation from fuel prices, what would you do?
Yeah, that's exactly right. I mean, the bank's primary mandate is to make sure that inflation is stable and low or within the target band. And so the big kind of question that they're asking themselves at the moment is, will we eventually need to raise rates to see off this inflation shock that's coming? And for the moment, that inflation is limited to energy prices. And so they can say quite rightly, well, we can hold rates where they are for now and look through that, but we're going to be very attentive. But there's always the risk that at the same time, as the inflation is arguing for higher rates, you get the economy weakening underneath that because spending is being reallocated to these inflationary categories that have inelastic demand. And so you might need to actually give some monetary accommodation to prevent the economy from stalling. Very challenging time to be a central banker. But what this employment data does is it says, actually on the margin, this argues for being a little more dovish, for holding rates a little more steady than we would if, say, the economy was running pretty hot and we were seeing this oil price shock. And it's interesting to compare Canada there to the US, where, there's just generally more inflationary conditions from the AI build out, from tight immigration policy, from tariffs, which mean that the oil price shock is coming on top of already inflationary conditions. And so we think the Fed will have to raise interest rates, whereas the Bank of Canada won't. And so you can run through the implications for relative rate differentials and, what might happen to the exchange rate as a result.
Dylan, I've got to leave it there. Thanks for your time. Dylan Smith, founder, chief economist at ARC Macro. Coming up next, U.S. job numbers also came out for April and exceeded expectations. Find out why the headline figure may not reflect the fuller picture. Back in a moment. There's been a huge drop in the amount of U.S. spirits that have come to Canada from the U.S. Canadians simply aren't buying American liquor. And now a new Nanos poll for CTV shows a majority stand behind the boycott. CTV's Abigail Beeman has more.
Running a big softball tournament this weekend has Thomas Ray stocking up on Canadian coolers. A boycott of American liquor hasn't changed things for him.
I just stick to what's available and what's delicious. Mostly Niagara Falls.
And you're happy to support Canada?
Super happy to support Canada.
More than a year after provinces started pulling American booze from Canadian shelves, new polling by Nanos Research for CTV News shows most Canadians maintain boycotting U.S.-made goods and travel to the U.S. is helpful to strengthening Canada's bargaining position. And even though the U.S. has made its irritation clear,
it is insulting.
It is.
And disrespectful.
Nanos found Canadians' boycott support is largely unchanged since October.
I think a lot of this has to do with the fact that there hasn't really been significant progress in the trade discussions with the United States.
I don't go there. I have family there. Haven't visited in a hot second.
I won't spend any of my extra money on anything from the United States.
That gives us leverage. We should know. We can't give that up.
I think they should bring back American products. A good bourbon once in a while never hurt anyone.
The American liquor lobby would appreciate that last remark after seeing a 63 to 67% reduction of exports to Canada.
Small craft distilleries in the United States are feeling that pressure. Some of them are starting to shut down.
But most provinces are sticking with their boycotts. Ontario's LCBO is one of the biggest liquor buyers in the world. 2 weeks ago, the premier said the alcohol only goes back on the shelves when the U.S. removes their tariffs. Abigail Beeman, CTV News, Ottawa.
So gas prices, of course, hitting their highest levels in 4 years. Drivers aren't the only ones trying to figure out how to adapt. Air Canada announcing new reductions in its flight schedule, and at least one insurance company is no longer covering cancellations related to jet fuel shortages. CTV's Andrew Johnson reports.
When Alexandra Antonovich books a flight to visit her parents, she looks for Air Canada's direct route first.
It just takes only 5 hours. Usually I would take connect flights, and that would be about double the time, even triple. With some strikes going on, it was once like a day and a half. So it's just convenient.
That convenient flight from Vancouver to Raleigh, North Carolina won't last long because Air Canada is ending the seasonal offering early on July 29th. The airline is also ending seasonal routes early from Toronto to Charleston, North Carolina, and Sacramento, California, plus Montreal to Austin, Texas.
The ones that they're cutting back are newer routes. They're not old routes. They're not LA's or San Francisco's. They're not Dallas's. They're not Chicago's.
WestJet also previously announced plans to slash its capacity by nearly 6% in June. John Graddick says along with the service reductions, Air Canada is primarily offsetting expensive fuel by raising fares.
You're in for some sticker shock because the prices have jumped significantly.
If you're buying insurance to protect you in the event of future cancellations, there is something else to consider. Manulife says it is now classifying the jet fuel shortage as a known event.
What that means is if you book travel cancellation or disruption insurance through Manulife after May 5th, problems related to this issue likely won't be covered. It might be a good idea to check with your insurance provider before making any new bookings. Andrew Johnson, CTV News, Vancouver.
Let's run through a couple of the market lines because we have a couple of reporting of earnings that are affecting the markets today. So here's where we are on the TSX, 193 points up on the day, over the 34,000 point mark. Materials moving significantly today, but I want to start here with Enbridge, which did report earnings for its latest quarter. Its gas revenue doing better than its crude revenue at this point. And stock today down about 50 cents, 73.22. That's despite the fact that the company, the pipeline company, did say it's added to its backlog, and that backlog sits at $40 billion. So there's a lot in the pipe, no pun intended, for Enbridge. But investors have obviously some more questions. They sent the stock down a little bit on the day. Let's go to TELUS, which also reported earnings. We know the telecommunications companies have struggled for some time. And there will be a new leader and also now a new CFO announced will be coming in June. CFO who has been there for decades now will be leaving as well. TELUS on their earnings down a little bit on the day, 14 cents to 17.40 a share. Let's get to Aritzia, Canadian retailer. Women's clothing reported last night and it was out of the park. That sent shares up 4.3%. They are doing well on all fronts, making a lot of money. People seem to like their product here in the U.S. and other markets they are in. And tech also doing well in the U.S. That's driving the markets there. We will give you the closing numbers for Bay Street and Wall Street when we come back. Here are the closing bells for the end of the trading day. At the Nasdaq today, it's the Minister of Finance for Chile. At the New York Stock Exchange, Enhanced is ringing the closing bell. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX ended the week on a positive note, up 228 points or 0.7%, landing over 34,000 points today. Let's go south of the border and have a look. The S&P gaining 0.8%, 61 points on the day, and that is a new record high for the S&P. The Dow Jones up only 10 points today, not a material move. And the Nasdaq up 1.7%, 440 points on the day. So a strong week for the Nasdaq as well. Let's move on to movers in Toronto. Teck Resources gaining 6.8% or $5.67 today, taking the price to $88.75. Materials were leading today for the TSX. First Quantum Minerals is also a gainer today. It's up 6% or $1.98. It's up 85%, almost 86% over the last year. B2 Gold today is also up 7.25% or 49 cents to $7.25. Let's get to the losers on the market. Brookfield Business Corp down almost 8% or $3.65, taking the share price to $42.18. They had some Q1 results reporting. And then Energy Fuels is down on a rating change. So it is down 8.1% or $2.58 to $29.27. Exchange income is one we are watching as well. It's down 5.7% or $5.92 to 98.74. And Moderna, if we can have a look at Moderna, they're reporting that they're working on a hantavirus vaccine. So that is a story and a stock we are keeping an eye on as well. American markets have been roaring this week, the S&P and NASDAQ getting to record territories. Let's talk about the strength in the markets with Keith Buchanan, partner and senior portfolio manager at Globalt Investments. Keith, thanks for joining us.
Thanks for having me.
Is the positivity this week, today, employment numbers or earnings, both? What do you see driving these markets the way they're going?
Well, we actually think it's both and. We've had really good earnings this week, has started to really get in the meat of tech earnings, all of which have been either slightly above expectations or blowing out of expectations, at least for the largest cap names that really matter the most to the larger indices. But also the jobs number really probably a little more of a relief that there wasn't more consternation about the labor market as we are really in the crux of a inflation scare that's emanating from the conflict in the Middle East. So there are a lot of concerns that seem to be, at least today, not to really turn on its head to really bring a lot of risk back to the marketplace. And the market really had some momentum coming into today, even before we even had those announcements. So it's been a really positive week for returns for equities.
Yeah, big positivity, big push from tech this week. Semiconductors trade up 11% in the last week. So clearly AI interest remains high. Are the earnings that you have seen in tech that strong, that good? Because we did see, for example, some of those tech stocks move a little bit down.
Some of the earnings have been, the earnings have been strong. I think we look at it a couple of different ways. The revenue, some of the cash flow coming from some of the largest investments and also some of the build out has not really disappointed. What a lot of questions the market has is some of the cash burn as far as the spending that's concerned with this build out has been larger than expected, and that's caused some concerns, particularly early in the earnings season. When we're trying to ascertain what are the returns on this cash flow has been really plowed into this new phase of infrastructure build out, the massive numbers really are really jaw dropping. But once you get past the shock of the massive amounts of spend, it gets to a point where you have to make the math make sense as to what is the returns you have on that investment and what's the time frame in which we can expect that return. So that's part of the math that has to come together at this phase of moving from just complete optimism, again, shock and awe, to now just making the math come together in a way that justifies the valuations that some of these corporations have. Some of them have grown into valuations at the earlier part of the spending phase. I'm thinking NVIDIA when it comes to mind with that. But there are certain names that are later in the cycle of this build out that we just haven't seen the valuations really fulfilled by the earnings growth really coming down the income statement. So those are still questions that we all have as investors, and questions hopefully that we'll get answers to over the next 6 to 12 months of this build out. Okay, let's talk about travel. Airlines held back by fuel prices. They're canceling some routes, grounding some flights. But you have noticed, I guess, that interest still remains strong? Sure. We're looking at the airlines are a group that we focus on for a lot of different barometers of macroeconomic activity, but also for positions in some of our equity strategies. And Delta is one that really stands out at this point. We're really coming back from business travel that has better margins than we've seen in the consumer space. And also they segmented the cabin in a way to really take advantage of a consumer that seems to be still engaged as far as paying for the experiences and the travel that we've really haven't seen in the past, as far as how many people are turning the turnstiles, going into airports and traveling to see relatives or just have those experiences that they haven't in the past. So that's a name that we're excited about. Also has, now that we've had this consolidation of the airline industry over the past 20 years, they're able to withstand energy shocks like we have now. And some of the names, like we have Spirit, that really is kind of the poster child for capacity, low-cost capacity that really struggles in times like this. Delta's on the other end of the spectrum, and in a way it even benefits as some of that capacity comes out of the system and they have a little more pricing power and rational capacity decision making has really driven this group to a level that we feel like the valuation really doesn't reflect yet. So that we feel like Delta is a great opportunity, even at these higher price levels for the stock.
Okay, I do want to get to consumer sentiment being very low in the U.S. And in this climate, Walmart is one of your picks, but is that on the expectation on inflation moving up and perhaps consumers then buying more at places like Walmart?
Absolutely. On the surface, Walmart seems like it could be a victim of the consumer sentiment sliding, particularly in the lower half cohort of wage earners. But what we've noticed is it actually has a trade down mechanism to their revenue and the traffic that comes in the doors of Walmart, where they have been able to benefit when consumers get afraid and when they are shopping to save some money on necessities that they have to have. So we look at Walmart as part of the solution of moving through a consumer environment that isn't really, that kind of holds back some and is a little more careful about spending. Walmart is positioned to take advantage of that, as well as the ad revenue that they pull in now really doesn't have a valuation, doesn't garner the valuation that we feel like it deserves, as well as a part of the Walmart kind of reimagining itself into more like an Amazon than the Walmart of old. So we're excited about the future for Walmart, particularly particularly in the spaces that have better growth, like the e-commerce spaces.
Keith, I got to leave it there. I'm out of time. Keith Buchanan, partner, senior portfolio manager at Globalt Investments. Thanks for joining us today.
Thank you.
Up next, U.S. job numbers data for April exceeded expectations. We'll find out what happened in the details for the sectors when we come back. U.S. non-farm payrolls exceeded economists' estimates, rising 115,000 in April. But our next guest notes the report contains some mixed signals. Let's go to David Rosenberg, founder, president of Rosenberg Research and Associates. David, thanks for joining us today.
Pleasure's mine.
So the rate of unemployment stayed the same, but there were fewer people looking for work. So how much did that play into this?
Well, I mean, there are lots of moving pieces in this report. I didn't think it was very strong. Of course, everybody focuses on the headline and the U3 unemployment rate staying unchanged. But the broader U6 unemployment rate, which includes all forms of unemployment, that actually went up to 8.2% from 8% in March. That to me was very important. And, everybody looks at non-farm payrolls. That was your first comment to me. But there's the companion report that's called the Household Survey. And it actually showed that employment declined 226,000 last month. And
okay.
that followed a 64,000 pullback in March.
Let me dig into it a little bit more with you. First of all, you said the unemployment rate doesn't take into account all kinds of unemployment. What do you mean by that?
That's right.
Tell me about that.
That's right. There's different measures of unemployment. So we focus on the U3, which is the classic unemployment rate. But the U6 includes all forms of idle labor resources, like discouraged workers or people who aren't officially counted in the labor force but would take a job if they were offered one. We get fixated on the headline unemployment rate. It's a very narrow measure of unemployment because you have to ask yourself the question, like, if this number was so good and if the labor market was so tight, then why did average hourly earnings, the wage part of this, and that was the real key. And if I'm at the Fed or I'm trading the bond market, I'm looking at all the inflation chatter because of oil. Average hourly earnings came in below 0.2% month over month. And that's the second month in a row that we had a print of, call it 0.2%, rounded to the first decimal place. Wage growth is slowing in the United States. And to me, if you're going to ask me, what is the most important segment? Of course, that ties into the fact that actually beyond the U3 unemployment rate, more slack was built up in the labor market. That's all these Fed hawks should be looking at. Because from my perspective, this oil price shock is going to hit the wall in the labor market. You know, we're going to be getting the CPI numbers next week for the U.S. The consensus is 0.6. Okay. This wage number was 0.2. So what does that tell you? It tells you that real wages were negative 0.4. And that followed a negative 0.6 in February. So all this is leading to is a contraction in real wages that's going to lead to a contraction in real spending. And all I hear about today is, that the headline non-farm payroll numbers, half of which was skewed by the birth-death model, but we can save that for another interview.
Okay, let me also ask you about something called the quit rate, which you look at. Explain what that is and what it tells you.
Well, the voluntary quit rate is it's also called like the job hopping rate. It's the rate at which people are leaving their job in search of greener pastures. I call it the take this job and shove it index. And it's a bellwether indicator of what? Of worker confidence. The more the voluntary quit rate went up, and remember, it was surging back in 2021, 2022, when the governments in Canada and the United States were paying people not to work, and companies had to continuously bid up wages to attract people, everybody, especially in the gig economy, were job hopping 1 month to the next. So the more that quit rate goes up, the more it shows worker confidence in the labor market. Well, that number, that quits rate went from 12.4% in March to 11.3% in April. That's the low water mark of the year. And all you have to know to put it in lay terms is that is just the maybe the most important behavioral aggregate in the employment report, which was the willingness and the ability of the marginal worker to dare to leave their job to go search for something with better pay. That number is going down.
Okay.
And that's consistent. And by the way, that is the best leading indicator for wage growth. And that's what I keep on trying to say to all the inflation phobes out there, including the folks at the Bank of Canada, that there is no sustainable inflation unless the labor market comes along for the ride. And that's why these central banks missed it on transitory back in 2021, 2022, and in 2023 is because we had a wage price spiral. It fed into wages. This is a totally different labor market. I say especially in Canada, but it's also a different labor market in the United States. All the classic measures of labor demand are going down. And all I hear about is inflation because of oil prices.
Yeah.
You know, if all the provinces and all the states raise their sales tax today by 10%, would you call that inflation? That would be a contraction in real wages, in real purchasing power, and then in spending. And that's what this is all about. That was the most important number to me because I knew the consensus, and we'll see if it's right on the CPI, 0.6.
Okay.
But we got 0.2 on wages. The most important, the thumbprints of this report is this for the economy. Notwithstanding the fact we're all focused on the AI craze. This number is consistent with a contraction in real wages, which is going to lead to a contraction in real spending, which in the United States is 70% of the economy. So I would say this was actually not a good number at all.
David Rosenberg, got to leave it there, sir. We will watch and wait and see what happens next. Thanks for joining us, David, founder, president,
Pleasure.
Rosenberg Research and Associates. Up next, shares of Enbridge ending the day down. We'll recap the latest results from that company in just a moment. Enbridge shares trading lower today despite exceeding first quarter earnings expectations. Our next guest maintains a buy rating, citing a strong project backlog for the remainder of the year. Let's go to Spiro Dounis. He's director at Citi Research. Thanks for joining us today.
Hey, Meryl, thanks for having me.
So profit down by $590 million year over year. Can you share why? Do investors need to be concerned about that?
Yeah, so I'd say when we look at it, we look at it from the EBITDA perspective. And on that front, they did surprise to the upside by about 2%. Big driver year over year and some of the movements was on the FX side, on the foreign translation. And so that's why we're not too concerned about it, something that's a bit outside their control. But if you look at the underlying business fundamentals, we were really surprised on the gas side. That's really where we saw the strength in their business. And a lot of it had to do with winter weather. It was much colder. We saw a lot of draws out of storage as a result. And then you saw a lot of the white space on these pipelines really get filled up. And that's something that we don't really expect to slow down, even counter seasonally here, we've got a lot of power demand driving the need for these pipelines and gas for these pipelines. Really, the only sort of weak spot we might have seen there was just on the liquid side, specifically when you sort of look to some of the U.S. Gulf Coast numbers that we found. It didn't meet the mark. However, the devil's in the details there. As we look forward, really only got 1 month of really strong benefit on the Gulf Coast. And a lot of that obviously had to do on the back of Iran, was a really strong draw for crude out of the Gulf Coast. And so going forward, we expect to actually for that to be a tailwind as well from here.
Okay, I just want to ask about gas, because you mentioned the winter weather, of course, meant a lot more reuse, and that was a positive for them. But if in the summer you're expecting it to be the same, what are you basing that on?
Yeah, so obviously you're going to have a typical seasonal slowdown, and we model that. And I think people are well aware of a typical sort of dip in these shoulder months here. But as we think about the broader thematic around natural gas demand, you look at some of the top 50 pipelines in North America, they're running at about 90% full in any given day. And so that rubber band is really being stretched. And so if you do have maintenance and supply outages, it tends to really spike the demand for some of these pipelines. And so as we think on the go forward basis, once again, the theme of power demand, data centers, AI-driven data center power demand is all keeping these pipelines very full. So sure, we will definitely see the seasonal slowdown. That's pretty normal, but I'd say the fundamentals underlying that are really strong still.
Okay, they've added to their backlog, now at $40 billion. What are the additions that are helping them there?
Yeah, so a few. So they've added kind of across the spectrum, and that's kind of what we like about Enbridge is you don't have to choose one commodity or the other. They're really hitting it on every different commodity group here. If you need more energy, you need more of what Enbridge has to sort of offer. And so as we think about what they added, adding some crude projects on the mainline side, adding some renewable projects on the U.S. side, and then also adding some gas and transmission projects, Vector being the big one up near Ohio. So kind of giving you a little bit of everything. You're right, they did increase the backlog to about $40 billion. If we think about what that means, it's about 4 years worth of capital spending. They spend about $10 billion a year on projects. So really great visibility over the next few years. I guess what's more interesting beyond that is they expect to announce another $10 to $20 billion over the next 24 months. And so really growing that backlog. And then what we don't see is another $50 billion of projects sitting behind all this that could eventually make its way forward.
Why do you think shares are lower today then?
Yeah, it's been a really tricky tape. I think if we have to look at what's really driving a lot of these stocks. There's two things other than the actual results themselves. Obviously, one would be Middle East headlines. Of course, drives a lot of the reaction any given day. I don't know that was it today. I think today was really more about positioning. If we think about the setup into a lot of these earnings prints, especially for the energy names, expectations are high. You've got really high commodity prices. You've got a good reason to believe that volume flows have been strong. But I think we've got to keep in mind for this first quarter, you're really only getting about 1 month of that benefit, of course, in March. And so I think expectations are pretty elevated. And we've seen from a lot of their peers, big gas beats and raises. And of course, with Enbridge, not nearly as direct commodity exposed. And so we didn't expect that big of a beat on that front. But once again, just simply where the market starting point was, expectations were high. We think they largely delivered on that, delivered projects, beat on our earnings print actually, but just didn't outsize surprise us.
Okay, the executives at Enbridge say the macroeconomic landscape strongest in over a decade. You talked about Iran being a part of that. How much of that is nation building?
Yeah, no, so part of it's really just about the supply disruption that's going to linger really beyond the near term, right? I think if you look at what a lot's being said around the sort of crude and supply disruption, you really got to go and backfill a lot of these inventories on the crude side that's been lost. And so this is probably going to take over a year to kind of correct on the other end. And for that reason, you're seeing a big draw from North American oil and gas. And so I think that's part of what they're talking about is all this interest to export more crude out of the U.S. and obviously from Canada down to the U.S. and out again. And I think as long as that's in place, the fundamentals look strong for the next year and a half. Even as you go to the natural gas side, I think you can make the same argument there. U.S. LNG and Canadian LNG is now needed more than ever, viewed as a stable source of supply. And so in that backdrop, we would expect there to be a lot of infrastructure build out to support what could be a new wave of demand on the back of this.
Okay, are there headwinds you see for Enbridge? One of them possibly being competition in the U.S., of course, to get things built?
I wouldn't say there's any obvious competition that hasn't been there before. If we think about it, still the large set of players that they're competing against. And I guess what's interesting on the pipeline side is it's very regional, right? And so I think you're going to see them compete just about as good as anybody else for those wins. I think their pipelines are really well situated in very close proximity to power plants and very close proximity to data centers. And ultimately, they've got pretty critical assets across the board when we think about the big themes, right? And those big themes, of course, once again, are data centers. We think they've got the right pipelines in the right place on that front. We think about LNG. They connect into all the U.S. LNG facilities and also have an LNG interest in Canada. And then if we think about the crude side, they are, roughly 2/3 of the egress on crude out of Canada. And then, of course, have a massive position on crude egress in the Permian, which is the premier basin in the U.S., as well as an export dock out of Corpus Christi. That is where most of the exports are going. So we think they've got all the right assets in the right places. No reason they can't compete.
Spiro Dounis, director at Citi Research. Thanks for your time. I appreciate it.
Thank you.
All right, coming up, private credit has grown into a $1 trillion market, but there are some doubts about whether that boom can keep going. Back in a moment. The private credit boom may be stalling. Bloomberg Original shows how AI is exposing hidden risks that are scaring off some investors, pointing to a possible reckoning for everyone involved.
It's been a tough few months for the $1.8 trillion private credit market.
The market is going through its biggest crisis of confidence in its history.
Private credit firms make loans directly to companies, giving them a way to borrow outside of banks and bank-led channels. They use money predominantly from institutional investors, but recently from some wealthy retail investors too, and became major lenders to software companies, especially those backed by private equity firms, which by and large had seemed to be going pretty well.
Now you just have this existential risk in the form of AI that can change everything, and private credit's just at the center of that now.
Late last year, concerned retail investors started trying to pull their money out. Blue Owl allowed investors to take 15% of shares out of one of its private credit funds. It also sold assets to return capital to investors and reduce debt. Others got more creative.
We did see some Blackstone employees basically pitch in some of their own money to help meet redemption requests.
But this wasn't enough to calm investors. Blue Owl's shares have fallen sharply since the start of the year. Industry-wide concern, though, meant it was far from a unique case.
People have been talking for years about how private credit has been untested, and this is the first time that they've really been under this amount of pressure.
Some observers have drawn parallels with the lead-up to the 2008 financial crisis.
It has the same trappings as subprime mortgage repackaging had.
While others say that fear is overblown, especially since private credit firms don't use your bank deposits to make loans. It's just really hard to assess because these loans are private.
Private credit lenders will tell you that they made really smart investments. But the concern is that, what if they didn't?
Good news, everyone. Today, you're going to learn the connection between one of these, lots of these, and even this. Private credit.
You can think of private credit as lending that's not arranged by banks.
It could be an insurance company, or in many cases these days, it could be a private credit fund.
These deals are managed by some of the biggest names in private markets, like Blackstone, BlackRock, Blue Owl, and even some not named after colors, Greek gods, for instance. But what is it?
It's really a very broad umbrella term that refers to multiple forms of lending. The type that's in the news most these days is what's called direct lending. And that's when basically these institutions lend money directly to companies. If you're a company and you need to borrow money, you might go to a bank. But if you're really, really big, a bank can't provide that much of a loan to a single company.
So instead, you go to the debt capital markets, where a bank arranges a bond or loan and sells it on to multiple investors. For a fee, of course.
Private credit is a way to accomplish the same type of transaction, but just directly between the borrower and the ultimate buyer of that debt, cutting out all those middle stages.
And it became central to the global financial system.
Back in 2015, I think this market was around $500 billion.
The overall assets under management for private credit is roughly $1.8 trillion as of today.
The $1.8 trillion market that most people talk about is just a subset of what some managers see as a total opportunity of as big as $40 trillion.
In other words, the current market's just the tip of the iceberg for private credit. Far bigger opportunities lurk underneath.
There's supply chain finance, there is consumer, auto loans, mortgages, there is railcar financing, there is different kinds of trade financing, music royalties.
We did a story last year about them getting into things that would have normally been financed by municipal bonds. A lot of lenders, especially places like Apollo, feel like the sky's the limit.
About 2/3 of the private debt market is in North America. Europe takes the next biggest slice, followed by Asia Pacific and the rest of the world.
I mean, you could say private credit has been around for decades, really. I think the 1980s is probably when a lot of this started. But really, back then it looked nothing like it does today.
One event in particular didn't so much grease the wheels as crash the car and set fire to it.
The 2008 financial crisis led to numerous regulations to try to keep that from happening again. And one of the key things regulators essentially said was they wanted banks to do less risky lending.
Regulators didn't want banks to make a lot of loans with their own money.
And that's what allowed private credit to sort of step in and start doing a lot of this stuff.
It can also help out when things get choppy in other debt markets.
For example, in 2022, the Federal Reserve had to start raising interest rates. It really caused some problems in the high-yield bond and leveraged loan markets and made those much harder to borrow from. And private credit lenders really stepped up, and they saw it as a massive way to grow their market share.
Now, their loans can be more expensive than traditional financing, but borrowers often accept that for speed, certainty, and longer-term relationships with lenders. And software has been one of the biggest targets for direct lenders in recent years.
A lot of these companies have very strong revenue growth, but they're not making money.
That's something that banks have a hard time financing, but private credit can do quite easily.
This is the S&P 500. And since 2022, firms like Ares, Apollo, Blackstone, and Blue Owl have seen their share prices generally outperform it as they expanded their credit strategies and grew their assets under management. Over that period, Blue Owl's AUM flew up from around $100 billion to more than $300 billion. But something else happened in those 4 years.
OpenAI is now valued at $852 billion.
Anthropic's making headlines almost on a weekly basis. Yeah.
The rise of AI has completely upended the private credit market.
So now the spotlight is on how much exposure private credit firms have to software.
And so retail investors in particular have been putting their money.
Shares of KKR and Blue Owl were down as much as 10%.
Blue Owl is one of the most exposed.
And it's why investors are trying to figure out if those loans were underwritten with sound principles
or based on overly optimistic growth trajectories that the AI revolution could now put in jeopardy.
Towards the end of 2025, Blue Owl co-CEO Mark Lipschultz was pretty confident.
Credit quality is excellent in our book, and that doesn't mean no defaults. Everyone's going to have defaults now and then. You just can't have many, and you have to get good recoveries, and that's exactly what we do at Blue Owl. And by the way, so do our peers, and so do the banks.
In November, though, it called off a merger of two of its funds amid scrutiny over potential investor losses. It coincided with redemption requests, that is, people asking for their money back, climbing sharply across the industry, including at Blackstone, Blue Owl, and Apollo.
There's really not a fund that's been spared over the last few months here.
We've seen huge funds receive massive redemption requests that are unprecedented in the history of private credit markets.
A lot of the firms that had made a big push into the retail market have had to deal with these redemption requests in an amount that was unprecedented. And to preserve the value of the funds, they've had to limit, in many cases, the amount of money that investors could take out.
In the first quarter, funds were enforcing caps and denying billions of dollars of withdrawal requests, predominantly from wealthy retail investors who'd sunk capital into special products tailored for them by private credit firms. In some cases, their unmet requests were tens of percentage points higher than the money actually allowed to be taken out. This all comes years after heavy inflows from institutional investors and retail-focused funds, much of that money going into software businesses that were seen as durable. Now, AI is starting to challenge that assumption. And all of this is harder to judge because the market is so opaque.
Some of the main drawbacks of private credit is there's much less transparency. Private credit are bespoke loans between sophisticated parties, and it's all private. Loans are not securities.
And crucially, that privacy means they don't really trade, so there isn't a market deciding what they're worth. Skeptics have begun questioning the accuracy of private loan valuations, particularly after a string of investments recently had their values slashed to zero, with little to no warning. It follows the collapse of subprime auto lender Tricolor and auto parts supplier First Brands last year. While only tangentially related to private credit, their demise raised broader questions about underwriting and hidden leverage across all credit markets.
Jamie Dimon has been sort of a vocal critic of the private credit market, is how I would say it.
The JP Morgan CEO was among the bankers facing losses tied to Tricolor, and he went full insect in his assessment.
My antenna goes up when things like that happen, and I probably shouldn't say this, but when you see one cockroach, there are probably more.
It's a very visual image of hidden problems coming to the surface, as cockroaches tend to do when lights go off.
But the bigger point that he was making is there could be more problems, and this could be just the beginning, and no one is really safe.
This is what led some observers to draw comparisons to what happened in 2008.
I think the counter-argument to that is that the regulation following the 2008 financial crisis intentionally pushed risky lending off of bank balance sheets and instead ended up with investors.
And so they can afford to lose that. They may not like to lose that, but they can afford to lose that.
We're not really seeing that sort of widespread distress just yet.
But definitely, I think we can say that the best days for private credit are probably behind us, and the next few quarters, years are going to be more challenging.
Coming up, tech companies race ahead with AI initiatives, but are they trampling on your privacy while they do that? We'll take a look when we come back. We know tech companies have been racing to roll out new AI tools, but how are they doing it? Are they trampling on your privacy? Are they getting to things they're not supposed to be getting to? A joint investigation by Canada's Privacy Commissioner and those in Quebec, British Columbia, and Alberta found that OpenAI's platform collected personal information without proper safeguards. Let's break it down with tech analyst Carmi Levy, who joins us now. Carmi, thanks for joining us today. Pretty concerning, I'm sure, to most Canadians. Is it clear where they scooped up this data?
No, basically everywhere. The open internet. So it could be any website, any blog post, publicly accessible social media content. But what's concerning, and the problem here is there's never been any transparency about what that data harvesting process looked like. It was basically the technological equivalent of a giant vacuum cleaner pointed at the open internet. What's concerning is the type of information that was included in that harvesting effort. It included private health information, information on political leanings, even information belonging to minors. And so kind of add it all up, and it shows that fairly reckless disregard for appropriate data stewardship policies. And as the privacy commissioners indicated in their report, clearly violated Canada's privacy legislation on a number of fronts. Very concerning. And the fact that this is the way the industry works, every large language model is trained in this way, and there are essentially no rules for dictating how it's done. OpenAI is being held on the carpet this time, but really it's the entire industry that should be on trial.
OpenAI is not based in Canada, so how much power do the Canadian authorities or regulators have here?
At this point in time, absolutely none. It was pretty clear that the privacy commissioners knew that they could say that they violated the law, but they couldn't actually do anything about it. Current privacy legislation, the Privacy Act, dates to 1983, created obviously decades before any of this technology was even created. So they can't specifically go after this kind of data harvesting or what was collected, how it was collected, whether permission was provided or not. None of that. There are no laws that apply. So they have called on the federal government to bring these laws up to date. But at this point, there's a yawning gap here, and we're kind of left with us relying on the largesse of the company to do the right thing. They say they've updated their tools, that they've addressed many of the issues raised in this report, but the reality is there's nothing that compels them to, and certainly no consequences for this kind of behavior.
And as you said, no transparency. Would it have been easy enough for them to train their large language models with parameters?
It certainly would have, but the problem here is that would have been a much bigger engineering lift for the company. It's a lot easier to just take a massive amount of data and then dump it into a database and initiate the training process than it would be to go through all of that information, vet it, take the stuff that is of low quality, pull that out, and only leave the data that rises to the top. And so this, again, is an industry, racing for the horizon at this point. They are competing, and OpenAI made it clear they were rushing to market because they felt other companies would outflank them. So they didn't have the time, they didn't have the resources, or even the desire, and certainly no one was requiring them to take those additional steps, do that additional due diligence on the data ingestion, and do it right. And unfortunately, they got caught this time, and I would suspect if we continue to investigate them, nothing much is going to change.
You hit on the right words there, due diligence. A lot of that is getting missed along the way these days.
Yeah.
Let's get to OpenAI in a court battle with Elon Musk. In your mind, what is this case really about?
It's Elon Musk feeling that he was wronged on OpenAI. Of course, he was a co-founder of the company along with Sam Altman, and then he left in a huff a few years later over the company's future trajectory. Elon Musk wanted it to remain a not-for-profit, and of course, now as OpenAI prepares for its IPO, that obviously it's on a different trajectory. And so Elon Musk feels that he was wronged. He feels that the money that he put in was also taken under false pretense, and he wants to hobble OpenAI before they go public. And obviously, that puts his company, xAI, which is responsible for the competing Grok platform, in a competitively advantageous position. So really, it's a billionaire hissing match, and Elon Musk got his feelings hurt and took him to court.
Okay, so while these two battle out, is there a winner in this scenario somewhere?
I mean, both of them are, depending on the day, right? One day Sam Altman has a bad day, the next day Elon Musk does. It's clear the judge in this case has no patience for either of them. So everyone is getting mud on themselves at this point. And I think we're starting to see light being shone on how this process works, how AI companies go to market, how they prepare to go public. But so no, I think both of them are losing here. And I think, quite frankly, the risk here, especially for OpenAI, is that as it prepares for its IPO, it's got a whole lot of this dirty laundry now being aired in court. And if you're an investor, you kind of have to wonder, what does that say about the future roadmap of this company if all of these skeletons are in this company's closet? So I think OpenAI at this point has the most to lose, but it's not like Elon Musk is going to come out of this looking good either.
Carmi, got to leave it there. Appreciate your time as always. Have a good weekend. Thank you.
Thanks so much, Morelli. You as well.
All right, when we come back, we'll check in with Bloomberg's Canadian finance reporter, Christine Dobby. Back in a moment. Bloomberg's Canadian finance reporter Christine Dobby has her eye on Honda's pullback from EV manufacturing in Ontario. She joins us now to talk about this. Thanks for joining us today.
Thanks for having me.
You spoke to a professor who says this is the only rational move Honda had. Why is that?
So for this piece, I realized that I occasionally play auto reporter, and I went back to a couple of years ago when I actually went to the announcement at the Honda factory when the Honda global CEO came over. Trudeau was there, Doug Ford was there, a lot of fanfare, a lot of optimism. And what has changed since then is pretty much everything. I think at the time when that announcement was made, Joe Biden's Inflation Reduction Act was making huge waves around the world. It came with all kinds of subsidies and incentives for green technology. And so countries around the world were scrambling to compete. The deal made a lot more sense in that environment. Since then, Donald Trump has rolled back a lot of those incentives. He's also, as we all know, engaged in a trade war with Canada and the rest of the world. And the tariffs on the auto industry are really hurting the industry right now. And part of what really makes the Japanese automakers position in Ontario work is their continental access, their access to the rest of the North American market. They're paying billions in tariffs right now, $5 billion according to the professor I spoke, and it's just something's got to give, essentially.
Let's get to TD, which is doing some heavy lifting in the GameStop offer for eBay. What did you think of that?
Yeah, really interesting, right? This offer got a lot of attention this week. It was there were a lot of questions around how feasible it would be. It's a $56 billion takeover offer for eBay. And the CEO, was repeatedly saying it's sort of half cash, half stock. Part of the cash would come from debt financing. And GameStop said that they had a highly confident letter from TD to put up $20 billion in debt financing. That's a huge amount. It would be one of the biggest debt underwritings that TD has ever undertaken. And some colleagues of mine and myself reported this week that, according to people we spoke with, that financing would assume that the combined company's debt was rated investment grade, and there are a lot of questions about whether that would in fact be the case.
All right, Christine Dobby, appreciate you joining us today. Thank you for that.
Thanks.
The Alberta Premier Danielle Smith was in Ottawa today, putting more pressure on the Prime Minister's government to get going on some major projects, like her desired pipeline to BC's coast. CTV's Rachel Aiello has more.
Welcome. Welcome back. Thank you for making the time.
Once the pleasantries passed, Alberta Premier Danielle Smith put Prime Minister Mark Carney on notice today about the need to make something of their Memorandum of Understanding to advance a new pipeline to the West Coast.
I know industry is getting a bit impatient. Albertans are getting a little bit impatient. And if we're going to move forward with that MOU, I hope it happens in the next number of days.
Alberta and Ottawa have blown past their initial April 1st negotiation deadline. And while they've agreed on some elements, sticking points, including around an Alberta carbon price, remain.
We have more to do.
The Premier's sharp words and tight deadline come as signatures are being verified on a petition that could trigger a referendum on Alberta separation.
I think in Alberta, there does need to be a demonstration that Canada can work.
The added pressure also comes as the federal government is launching consultations on more environmental reforms that would ensure project proposal reviews from across the country take no longer than a year.
I am hopeful that the Prime Minister and I will find a path to ensure that British Columbia's projects get the same level of attention from Ottawa.
Premier Smith emerged from her meeting with Carney saying she was feeling a lot more confident about finalizing the MOU before submitting Alberta's proposal for a West Coast pipeline to Carney's Major Projects Office in June. She also said she hopes to get a yes within months.
CTV's Rachel Aiello reporting. Let's have a last look at how we ended the day and the week on both Bay Street and Wall Street. The TSX Composite gaining 221 points today, so 0.7%, taking it over 34,000 points today. The S&P 500, another record close, 61 points up, or 0.8% today, ending the day at 7,398. And then a record close, a new one for the NASDAQ. It is up 440 points, or 1.71% at 26,247. We had a couple of Canadian stocks we were watching today. Enbridge was one of them. It reported earnings and reported an incredible backlog of $40 billion in its pipeline. But investors clearly weren't loving it. They took the stock down by 39 cents to 73.33. And let's get to Aritzia if we can quickly, because that company reported earnings yesterday. Canadian retailer. They make women's clothing and accessories, and they are firing on all cylinders. Stock is up 4.5% today. 148.35 is where it ended the week. Thanks for joining us today on The Close. We will see you back here on Monday.